Good morning, everyone, and welcome to the first webinar of this week. It's the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com, and today is Monday, it's the 10th of January, 2022. Just going to bring up our high-risk investment warning. I'm going to keep this on screen for a few moments. There won't be a US Open today, I just want to let everyone know, but we're going to try and resume those tomorrow, and we'll carry on developing the scalping methodology, which seems to be, I think, pretty near completion. Just going to bring up our market commentaries disclaimer. I'll keep this on screen for a few moments. Hey, Kobus. Yeah, it was okay. Unfortunately, we were stopped. So Kobus just asking how was the NFP trade, but it's been recorded. So just send me an email, and I can send you the link. Or if you go onto our Insights, I've uploaded it onto our Insights webpage, so you can go there and check it out. Hey, Howard. Good morning to you. Yeah, had a great weekend. Hope yours was good too, and thank you everyone for joining. Let's just bring up the sources page, and so we'll do the analysis on 2.0. We'll start off reading just the cnbc.com morning note. I might reference TradingView, but the actual chart I'm going to show on the St. Louis website, which is called Fred. All right, so we'll just take a look at these based off of what happened on Friday's non-farm payroll. Let's start off with the CNBC morning note, and well, the headline reads, European markets head for positive open as investors await more US inflation data. And I think the Fed's got a real inflation issue on their hand, just taking a look at that wage inflation that we saw on Friday that was much higher than forecast. All right, so let's see what the notes say here. Yeah, I'm sorry about these ads. I've never seen them before. They're just popping in all of a sudden. All right, so the European stocks are expected to open in positive territory on Monday as global markets look out for key US inflation data this week and more comments from US Federal Reserve Chairman Jerome Powell on interest rate hikes. Global markets have a busy week ahead with the latest US inflation data, a key data point this week. The US Consumer Price Index is set for release Wednesday, and the PPI is slated for Thursday. So these are going to be big news releases. I think that I think inflation here is a real concern. Make no mistake, it's a real concern. And the Fed has been, I think the Fed has been behind the curve from the get-go. And I think the market thinks that the Fed's been behind the curve from the get-go. And I think they put themselves in that position, but when they changed from an absolute target to an average target. So we'll see how they manage this. All right, let's just, consumer prices have jumped in Europe and the US over recent months. Last Friday, inflation in the Eurozone hit a new record high in December, coming in at 5% compared with the same month last year. 5% in Europe. It's it's remarkable that. Hey, Katie, good morning to you. Nice to have you on the webinar. Now, in addition, investors will be looking out for more comments on the timing of forthcoming interest rates from Powell, as the Fed chair is scheduled to testify Tuesday at his nomination hearing before a Senate panel. So I think it's coming in March. I think the market thinks or expects it to come in March. Something I think dramatic has to happen between now and then for it not to come in March. And then the normalization of the balance sheet. I think that probably starts, I would imagine, sort of from June. Just want to think about that balance sheet for a moment. Yeah, it's just, I don't know if they'll be able to normalize it to previous levels. In other words, the level of normal, in sort of quotation marks, may have changed. I think they're going to have to keep a significant amount of assets booked on the balance sheet. I think that if they suck up too much liquidity from the economy, I don't think that the economy actually will withstand that if it's mismanaged. So we'll just have to see how that, I guess, how the Fed decides they're going to work that through. And the Fed has signaled it could dial back its easy monetary policy more aggressively than some expected. Minutes from the Fed's December meeting released last Wednesday showed the central bank is planning to shrink its balance sheet. Okay, we spoke about that. Markets will be keeping an eye on security talks between US and Russian diplomats in Geneva on Monday that are aimed at de-escalating tensions over the Ukraine. On the data front in Europe on Monday, the Eurozone releases its latest unemployment figures for November. And Netherlands publishes manufacturing output data for November, and Italy releases its industrial sales figure for the same month. All right, I think that's everything there. All right, so let's just take a look at, so this is the participation rate, which is the same chart as this, same chart. The source is actually from Fred. So, but this is TradingView. You can see the participation rate is trending upwards. It's Friday's release was flat in terms of participation rate. So we'll just keep an eye on it. The participation rate in the US is lagging other industrialized economies, but the fact that it's starting to show some sort of trendiness, in other words, higher troughs followed by higher peaks, suggests a little bit of, I think, comfort, because this was a conundrum. Why is the US participation rate not increasing? So we'll just keep an eye on that. In terms of, let's go to this one first. Okay, so this is what we call U3 unemployment. This is what got quoted on Friday. Most indications of unemployment will quote U3, unemployment 3. It's a definition of unemployment. It's quite a narrow definition. So we had 3.9%, and prior to COVID we were at 3.5. But I mean, 3 is tight on U3, and then you've got something called U6. U6 is probably more accurate. It's a broader definition. So this is the U6 number here, and you can see the definition here includes total employed, part-time employed, total employed plus all persons marginally attached to the labor force plus total employed, etc., etc. It's a broader definition. That's U6, and too far in. Okay, let's just zoom out of it. And you can see we're pretty close on the U6 level to pre-COVID level. So we are at 7.3. So roughly, 30 basis points or so away. But certainly, I think the labour market seems to be tightening up. Something else just to bring into the discussion here before we start looking at the charts is the Phillips curve. I'm going to just bring up my Microsoft Word, not Word, Microsoft Paint. So And the Phillips curve's actually been sort of, dare I say, broken for a few years now, but it looks like it's starting to kick in. Let's see if I can remember how to do this. So you've got inflation on the y-axis, and you would have unemployment on the x. Okay, so in other words, anything to the left here means the more people employed. So just to not confuse anyone, the unemployment rate, if it's shrinking, means more people in the job market. And then you'll have a curve that kind of looks like this, roughly. Something that kind of like sort of moves in like this. And then, so what happens is, as unemployment decreases, the Phillips curve suggests inflation moves up. And inflation's been quite a tough target over the last few years, except over the last 12 months. Only now we've got the unemployment rate coming in, and we've got inflation shooting up. And this is what central banks look at. This is kind of central banking 101. So the Phillips curves is back in play here. And by and large, the fact of the matter is the wage rate was a huge surprise up on Friday, but the headline numbers were constrained. We missed the headline. I think that there's more concern on the inflation side, because sort of perhaps something that we can suggest here is that because we're getting so tight in the labour market, one would I think be forgiven if they saw the job market kind of going like this, kind of tapering off. In other words, as you start heading towards full employment, well, you can't create 500,000 jobs, or 700,000 jobs when your labor supply is starting to tighten. And that's a possibility of what's happening. So maybe we kind of seen this taper. So I would expect that the inflation is the big concern here, because certainly the labor market seems to be responding, because the Phillips curve is back in play. I think that that's the big conundrum for central banks at the moment. One other thing that I'm going to just mention before we get into our analysis. Rob asked, will the normalization of the balance sheet lead to losses? And I expect it would. But just the thought that occurred to me is there is something, Rob, called Macaulay Duration. It's I'm not a fixed income expert by any means, and I would suggest Macaulay Duration is not often used. I don't think it's got much practical application. But what it basically does is it calculates, it offsets income versus price. So the idea would be kind of something like this. So let's just say you've got a bond. So this is kind of when you buy it. Let's say you buy it on issue, and let's say it matures in 10 years. So it's sort of a US 10-year, or whatever. As long as you hold it until maturity, you'll earn the coupon. Right? You're not really concerned about price fluctuations because you're entitled to the interest payment. But that's not what the Fed's doing. The Fed's not holding something until expiry. It's going to start normalizing its balance sheet. Well, there'll be an interplay between income and the the price, and there's something called Macaulay Duration, and it's kind of a I don't think any fixed income sort of analyst really would use it. Not on its. They would kind of use it to derive other durations, but the Macaulay duration says if you're not holding a bond, if you're not holding the bond for the full term, okay. So let's say you sell out at some point. The question is, will the price, and let's say interest rates are fluctuating, will the price that you get out be to your advantage or disadvantage? And if I remember correctly, so subject to correction, anything to the left of Macaulay duration, I think potentially there is a chance of capital gains. Anything to the right of the Macaulay duration, I think you could potentially go into loss. I could be mixing this up, but my point is that whether they sell at a gain or a loss, I think would largely depend on this Macaulay duration. So just wanted to put that out there. I would expect, given the fact that we were close to the zero bound, in other words, income is negligible, right? When you're close to zero, you're earning no interest, right? Well, and your price of your bonds may be quite sensitive to that type of rate. Well, then you are probably looking at losses. So I just wanted to add that. All right, let's go through to the DAX. All right, so take a look at how we ended last week. We've got this big inverse candle here. This is quite a horrific looking candle. What effectively has happened here is this is how last week played out. You had a week where the DAX was bid up, and then at the high for this week, you actually had a capitulation by the bulls. Bears take over, and we kind of closed just above the open. So the question is, who's in control at the end of the week? And it's the bears that are in control at the end of the week. And now, if the bears are in control at the end of the week, the logical question is, okay, are they going to follow through this week? So that's the question that we've got to try and sort of be aware of. And the way this could play out at the end of this week, we want to measure if price is below this line and closes below this line, because if it drops below this line and closes below this line, then we have a reference candle to the downside. And if we have a reference candle to the downside, I think then we want to keep an eye out for the next higher trough and see if we can get up, move up. So just this is the sort of line in the sand for a potential bearish reference candle, and so not a great candle for last week. We'll see how the price action develops for this week. Right now, I mean, we're looking at a weekly, so we haven't even got through to the first session, or the first trading days just got underway now, a minute ago. But the idea is this it's not really fair to take a look at the range of the candle so far, because it's completely engulfed in last week's candle. So the fact that it's completely engulfed in last week's candle shows what we call an indifferent, I beg your pardon, an inside week. But it's too soon to call it an inside week, because we've got practically 100% of trade left, right? So we'll see if we can get some sort of inference out of the range of the weekly candle as the week develops. So we'll go down to the daily chart here, and I think this is what we'll concentrate on for today. And what we can do is, let's take this out, and let's take this out, is we want to monitor trend here. Okay, so we're right on the border of zone 1 and zone 2. If we move from zone 1 into zone 2, that's in effect a bearish move on the daily. So we want price to hold in zone 1. So how are we going to measure that? And I think that if we can keep an eye on Friday's candle, which looks like it's a reference candle itself, and we want to see if price can move above that reference candle's high, well, then we may have the next leg. Okay, in other words, we may have something like this. HT question mark. Now, the problem is the market can be spooked by the inflation numbers this week. And of course, we read earlier there's going to be a testimony, and the market may be spooked by that. In other words, a normalization of the balance sheet, what we said earlier, has to be managed correctly, because if there's too much drain on liquidity, I think that the markets may not be able to withstand that. Definitely sort of in the short term, it's going to have to acclimatize. So we just want to see how that's handled. So the key here is, are we going to stay in zone 1, or are we going to slip into zone 2? And I think that as this week develops, it's a fairly big week in terms of this of monetary policy. Not so much in that the banks are delivering a monetary policy, but it's in terms of communication. So let's just keep an eye on that. Now, again, take a look at this candle. That's today's candle compared to Friday's. At the moment, it's an inside period. Okay, it's completely engulfed within last Friday's candle. In other words, bears haven't really decided to push prices down, but bulls haven't really decided to push prices up. There's a bit of indecision here. Again, it's probably not fair to call it an inside day just yet. We're 5 minutes into the European session. The only session that's been traded is the European, is the Asian session. So let's just monitor this. I think that we're kind of sitting on a knife edge at the moment, and I think the fact of the matter is zone 1, zone 2 is going to play out in terms of our map, in which way the market sentiment tends towards. All right, so I've come down now to the hourly, and let's just put in a FID here. All right, so we've pulled back 76%. Now, I don't really think 76% is a significant number, except for the fact that it's a heavy pullback. In other words, how much is still to go? 76 is, we've wiped out basically 3/4 of this impulse move here, and we want to see now. Okay, we've got a potential bullish cross here in the exponential moving averages. Is there going to be angle separation here? Because that's what we need. Angle separation is a sign of trend. Well, it's a bit suspect at the moment, and we've got the stochastic that's crossed over. So the stochastic has triggered, the EMAs have triggered. Does that mean that we're moving up? No, not necessarily. It all depends if we can make our way through to the 80 and hold. Okay, so if we can't make our way to the 80, in other words, the stochastic rolls over and starts heading down, that's not a great sign. If we head into that 80 and hold, well, then I would expect the angle and separation here. Then we have some traction to the upside. Then we can see if the Friday's high is in target. And of course, then we can go back to our weekly and just see, all right, is there any way we can get above this resistance? So kind of stuck very much in in my opinion, a very tough trading environment. We've got technically no real direction on the weekly, albeit that it's right at the beginning of the week. We've got an indecisive daily. Okay, so we still need some sort of directional bias on the daily, and the hourly, okay, has to show either a movement into 80 and hold, or a rollover and down. And I think then it becomes clearer. And with all of the technical confusion, we've got important fundamental calendar events this week. CPI, PPI, plus a testimony. So it's a tough environment to start the week. All right, there's a few questions here. Katie asking for Nasdaq and oil. Yeah, we'll go through that. Shadrach asking for euro and pound. Katie, am I planning to resume Friday educational webinars again? I can. Let me. I haven't got anything scheduled at the moment, Katie. I'm happy to take suggestions, by the way. Let me give it some thought, and I'll see if there is something that we can build into those. All right. Let's take a look at oil and Nasdaq first, and then we'll go through to euro and pound. Okay, so let's go to oil. I think let's use this chart. Let's put in our peaks and troughs here. Okay, so the question here, of course, is do we get above this peak? And the answer is, well, it depends on the momentum. And of course, we've got a positive cross on our stochastic, and it's making its way to 80. If we make the way to 80 and it holds, it will see higher oil prices. And I saw a price target from one of the big banks. I think it was Morgan Stanley, subject to correction. I can't remember if this analyst was Morgan Stanley or Goldman, and I know they're very different, so I'm begging your pardon. But there was a target. They put a target of about $100 on that. So I don't know if 100 is going to be hit or not. Nobody does, but we'll see if the stochastic makes its way to 80 and holds. But certainly a higher trough here shows strength. Okay, is this a higher trough? Yeah, it is slightly higher. Let me just make sure measurement's right. Yeah, slightly. Okay. So the idea here is, in other words, the bulls didn't let price fall back to the lows here. Some sort of support coming in. Are they able to push? Are they able to push the price of oil towards that 100 level? If we go through to our dailies, we're in zone 1, and you can see that well, this is actually looking quite interesting. We've got a trigger here, we've got a trigger here. Again, just like our previous chart, doesn't mean that there is going to be a higher oil price here. Well, the triggers have been pulled, so that's the first hurdle. The second hurdle is really to get the stochastic into that 80 level and hold. And if that happens, I would expect higher oil prices. Let's just take a look at Nasdaq. All right. Let's just clear this up. I think we have to look at this with fresh eyes. All right, so I think that Nasdaq here is in a bit of trouble, KD. That's my sort of gut feel. We'll see if I'm sort of incorrect here, but we've kind of got this peak. Let's put this as a trough here. We'll put this as a lower peak. And we'll just see if let's see if we can break below this. Take a look at the stochastic. It's pointing down. So in order for me to be incorrect, we'll need to see a positive cross and movement back towards 80. So I think that's key. The reason that I suggest that the Nasdaq may be in a bit of trouble here is it really comes down to the fact that there's going to be most likely, I don't see it any other way, to be honest, we're going to see higher interest rates. And I think that higher interest rates are going to hurt the Nasdaq the most. All growth stocks get hit hardest. Growth stocks get hit hardest by increase in interest rates, and because of that, I would expect there's going to be a reallocation. So if portfolio managers are still looking to be exposed to the stock market, and I would expect that they would, well, they would be thinking to themselves, which sector poses the least risks. Portfolio managers are always thinking about risk. Where's the least risk? They're always thinking risk. Okay. Well, the least risk would be sort of a more value cyclical based type of index. So I think that the Nasdaq has a real chance of underperforming here. We'll carry on monitoring it. If anybody's interested in the mathematics of that, we can do it, but it really comes down to the time value of money. So I'm just reading this comment from Robert. Do you think the NFP actual numbers are becoming less important with the numbers of payroll employees rising? Clearly the trend is still important. I think that in my opinion, look, the headline number clearly was a disappointment on Friday. There's no getting away from that. But at this point in the cycle, is the disappointment in the headline number as serious as, say, it would have been 8 months ago? And I think in that respect, the answer in my opinion, again, is no. There has been a significant and visible improvement in the job market. I would personally like to see the participation rate move up more. If you had to ask me, out of all the job metrics, which ones are you focusing on, Russ? For me, participation rate and wage inflation would outrank headline job creation and unemployment rate. Unemployment rate, we know that we are 3.9, you know, on that U3 number. That's a terrific number. I mean, how much lower can that go? And it tends to sort of lag. I think that the most obvious effect of just how tight the market is would be in wage numbers and participation. In other words, are those disgruntled, you know, the guys that just had no inclination to actually go and look for a job, or have those guys come back into the job market? Because if they have, well, that's telling us something. And if wages are starting to rise, well, it must mean that the demand for employees is outstripping the supply, because wages are being bid up. So on that basis, I think that given that the job creation now has largely been done, it's now we're kind of looking at the fringes. You know, are those discouraged workers coming back in? Well, that's big, because last NFP, not the one on Friday, the one before, we saw a jump in that participation rate. I think that's the big story there behind the headline number. And then the wage inflation, that was a big upwards move. That's got to be inflation at the moment, I think, is also a big concern. So I'm not sure if I've completely answered the number. I think that the metrics that are more important than the headline NFP, that's the point. If we had to see a negative NFP number, well, that would be a concern. Well, why would there be a contraction? But we're not seeing that. Jobs are still being created. The wages are being pushed right up. Well, the demand's there, the supply is not. So does that answer the question there, Rob? Or at least help at all? Okay, cool. All right, let's just take a look. So the Nasdaq, I think, is starting to show signs of weakness. If we go down to the daily, you can see we're in this zone 3 here, and until we get out of the zone 3, KD, I'd be very very cautious indeed. We've got to be careful here, because one of the good ways to have sort of tackled the Nasdaq, say in the last 12 months, is to wait for these pullbacks, apply cash to the dips, and know that, well, there's going to be some sort of appreciation. You just have to be patient. I'm not so sure that's going to work this time, okay? And the worst thing to do here, I think, would be to think, well, maybe we should buy the dip. I think we better do some of the math here just to drive the point home. The fact of the matter is we've got a lower peak, so the weakness is starting to sort of manifest. So I think caution needed there. Let's just do some math very, very quickly. But I just want to drive the point home. All right, so we've got. I'm going to just throw in just stupid numbers. Okay, so we're just going to put in interest rate at 10%. Okay, let's put in here time, which time equals 5 years. And let's put in here a cash flow. Let's call it a dividend of 10 bucks. Okay, let's see what we got here. So the time value of money formula would be as this: 10 divided by it would be something like this: 1 plus 10%. Okay, and then we would raise this to the power 5. Okay, and that would give me. Let me just pop. I'm just going to put this into my calculator. Hold on 1 second. All right, 1 plus 10%. And we're going to put that to the power 5, and we'll divide it by 10. And we get something, didn't key in that quite right. Hold on 1 second. I did. Okay, so you actually get a present value here of 6.2. Okay, 6.2. Now, let's just say that this interest rate goes up to 15%. So we're going to change this to 15%. All right, so then we'll get something like this. 10 and we would put it in like this: 1 plus 15% to the power of 5. Okay, so what do we get here? All right, so we'll get a present value of equal 4.97. Okay, so let's now do the same calculation, but instead of 5 years, we're going to make this, just make it 1 year. Okay, just make this 1 year. All right, so we would have it like this: 10. I'm just going to type it in like this, divided by 1 plus 10%, and it would be to the power of 1. Okay, which is basically just 1 plus 10%, and that's going to equal 9. It's going to equal 9.1. Okay, and now we're going to do the same thing over here: 10 divided by 1 plus 15% to the power 1, and that's going to equal 8.7 rounded. Okay, 8.7. So what's the takeaway here? So this is why I think the Nasdaq's in a bit of trouble. Okay, in that the top scenario here is basically a sort of a very simple model of the Nasdaq. In other words, Nasdaq is growth companies. Growth companies tend to retain their profits and reinvest it until they reach that sort of critical mass. In other words, the likelihood of you receiving a dividend from a growth company is sometime in the future. Once they've reached their sort of mature stage, then they'll say, okay, let's start returning some of our profits to shareholders. So you're going to get your dividend of 10 bucks only, say, in 5 years. You only get it, say, in 5 years because they need to retain it. Whereas a more sort of cyclical, established mature company is already paying dividends. They've reached the mature. You know, they started, let's say, at the beginning of the 20th century, right? They've kind of matured. They're your bricks and mortar. These guys, there's no real growth left for them. They've grown, unless they follow acquisition or something, but organically they can't really do much. So they're just returning cash to shareholders. So you'll get a dividend from these guys every year. So you can see that the increase in interest rate from 10% to 15%, well, that actually hammers, okay, the growth. Okay, it drops from 6 to below 5, whereas your more mature, kind of more stable, isn't it? 9.1, 8.7, and that's the mathematics behind it. So I think that as we start seeing tighter monetary policy, well, this top case actually should have gone like this. This top case, that's probably going to impact quite negatively on Nasdaq. So I hesitate, and we're in zone 3. Yeah, that's why we're getting hammered so badly on Nasdaq. If you take a look at, say, the Dow, which is a much more cyclical blue chip type of index. Let's see where we are. Oh, yeah, we're not in zone 3. Yeah, negative rates are hurting it, but nowhere near as bad as that Nasdaq. See that? All right, just 2 more to do: euro and pound. Let's go there. All right. See, I tell you what, Shadrach, this is, again, it's not an easy chart. So the trend is down on the weekly, but we've kind of stabilized over here on euro. Okay, we've stabilized. You go through to the daily chart. It's kind of fought its way into zone 1, but now it's testing that. And you can see the volatility has, it's not there just yet. We're kind of still moving sideways. Just take a look at the pound. All right, so the pound is strong on the daily. Taking a look at it on the weekly, I still think that this is a suspect rally. I think when we take a look at the euro and the pound, in my opinion, what it really comes down to is the US dollar, which way the US dollar goes. I think that's going to be the ultimate influence, Shadrach. And we didn't get the higher trough last week. Okay, we didn't get the higher trough last week. So we'll just put this here. Okay, but the idea here is if the dollar starts moving and we do get that higher trough, in other words, price closes above this, I think we'll see euro coming down. I think we'll see pound coming down. And I think there's a strong chance of dollar appreciation because of just the sheer aggressiveness of that Fed minutes. It's just a matter of watching the market, being disciplined, being patient, waiting to see when the market starts repricing that in. And again, it could happen this week when we hear the testimony and when we get the inflation numbers. I hope that helps, Shadrach. It's not clear cut yet. It hasn't. The market's still, in my opinion, very much dependent on dollar direction. And this dollar, I just want to watch it a few more days. I hope that helps, Shadrach. Any other questions? Anything else? Just go ahead and type that in. All right, no US Open this afternoon. Hopefully we'll get that up and running tomorrow. Thank you very much for joining this morning. I look forward to speaking with you guys same time tomorrow. Cheers.